Hey everybody, good to be here. My name is Brent Moores and time for Advanced Option Strategies. So glad to see you're joining us, whether you're watching live or on the recording. That's great as well. We do this each week at this time. And this week, what I want to talk about is a strategy that is going to give you a positive time decay, higher probabilities. It's a directional strategy, but it's a strategy that we really don't talk about that much when you look in the options world. But I think it's something to consider, and that are front ratio spreads. So we're gonna cover that, front ratio spreads, today. And I'm joined alongside Cameron May, who's helping me out today. Cam's a good friend, and he's an excellent instructor. So encourage you to check out his webcast. But as you have questions, you can type those questions in the chat between Cam and myself. We'll do our best to help you out. You can also follow us on X at Brent Moore CS, at Cameron May CS, for some additional content throughout the week. Options do carry a high level of risk, though, and are not suitable for all investors. And the information I'm going to go through today is for general informational purposes only. It's not a recommendation of any security, chart pattern, or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. And for the sake of simplicity, I may not include commissions. We may not always look at commissions and fees on these trades, but just realize they are a real thing that you need to consider. And the trades we're going to go through are for educational purposes. We'll go through actual trades, but they're not recommendations. They're just samples. All investing involves risk, including loss of principal. Short options can be assigned early, regardless of the in-the-money amount, and there's no execution that a stop order will be at or near the stop price. Oh, okay. I think we got through the disclosures there. Yeah, just glad you're here today. So basically what I want to do today is I want to talk to you about the basics of front ratio spreads. What is it? We talked about back ratio spreads a few weeks ago in this class. Well, you probably, that kind of begs the question, if that was a back ratio spread, what's a front ratio spread? Well, we'll talk about that. And we're going to talk about, look at examples of them, to try and illustrate what we're teaching through examples here. So that's going to be our goal. So when we talk about front ratio spreads, I want to get out some information on, but let's just take a quick look at the market, because I think that's relevant to you. By the way, if you want a more in-depth look at the market in a couple hours, I'll be teaching that Market Movers webcast later today here, just because that's Ben Watson's webcast. He's normally there, but he's in Chicago right now. So so this is the S&P 500. We've had the pullback, and is this a resounding trend change? Probably not. I mean, it could be worse. We bounced, but now we've been kind of going sideways. Right now, you'd have to say the general trend is still down, though. I mean, is this going to be a bear flag, or is this going to be a reversal? Probably too early to tell. But right now, the trend has been down. That's a 20-day moving average, by the way. They're on that chart if you find that helpful. So here's what I want to do, though. What I'm going to do is I'm going to go up and I'm going to bring up just a Word doc, because I want to talk to you about front. You know what? I'm going to make this all caps here. Front ratio spreads, okay? And then I won't do caps on everything else. But I'm just going to kind of go through principles of what you need to know of front ratio spreads, both what they are by definition, and pros and cons, of course, because there's always pros and cons to any trade you do, and maybe some management and some best practices, perhaps. When I say best practices, just practices for this class, the way we're going to teach them. What I'm teaching is not meant to be a universal declaration of how they need to be taught or anything like that, or how they need to be traded there. Okay, so the basics is you're going to sell two contracts. Typically, it doesn't technically have to be two contracts, but we're going to say two contracts, because that's typically how we're going to do it, and buy one contract, okay, of the same month. And these can be calls or puts. Now, they have to be all the same of any one trade. So we're going to sell two calls and buy one call on one trade, or we could do it reverse there if we want, and we'll do puts on that. Okay. So one way to kind of think about this is, so you have this uneven number. We talked about back ratio spreads. Back ratio spreads, by the way, were you're buying two contracts and selling one. Pros and cons to both. We'll get to that con here in just a sec, but one of the pros maybe, well, let me get to that in a sec. But basically the way to think of this, I think one way to think of this is that you're going to finance the cost of a debit vertical with an extra short option. Okay, there we go. So let's do that. That's the second thing. Now, something I mentioned before is these are directional trades. Directional trades. Okay, these are our directional trades. So it's sometimes we do iron condors or butterflies or calendars, which are more neutral type trades. This is actually going to have much more of a directional bias, more like a diagonal spread, for those of you who are familiar with diagonal spreads. Number four, these are, well, actually, before we get to number four, let me just mention this. Welcome, Chicago. We actually have an advanced options workshop in Chicago right now that has actually joined us, which is wonderful. Hello to everybody in Chicago. You know, you're in good hands with Ben and Scott and Ray, and Barb is out there too. Chicago's one of my favorite places in the world. You know that. I love Chicago. And you know, well, on a weekly basis, Ben actually teaches this. When I'm out, Ben will often sub this class for me and teach this webcast for me. So I appreciate Ben for many reasons. I do invite you each week at this time. We do teach this advanced options webcast. So good to have you out there. Now, let's continue our discussion of front ratio spreads here, everybody. These are, we mentioned directional. They're typically good for a higher implied volatility. I'm just going to abbreviate implied volatility with IV environment. And if you haven't looked around, environment, if you haven't noticed, we have been in a little more higher volatility. Now, implied volatilities have come down. That VIX has dropped a little bit, but you know, still by most measures, implied volatility is fairly high. These are positive theta trades. In other words, time decay actually is going to help us on these trades that we're going to do. Okay. Something to remember, you know, I mentioned you can do put ratio front ratio spreads or call front ratio spreads. Put FR, I'm just going to abbreviate FR, spreads are bullish. Okay? That may be a little bit reversed in what you're thinking, because, you know, normally if we talk about a debit vertical and it's a put debit vertical, then that would be a bearish trade. But it's kind of opposite here. Call front ratio spreads are bearish. Okay, so these are just kind of, and we'll get to the exact examples here to illustrate these in just a sec. I just want to kind of do a quick data dump on you here on this, so you get this down. You collect premium up front. Okay, that how we're going to do them. We're going to collect premium up front. I suppose it doesn't necessarily. They could be a debit depending on what strikes you choose, but the way I'm going to show you, we're going to collect some premium up front. A lot of people like that. I mean, that's kind of nice there, collecting that premium up front. And where they're going to be high probability trades. And that may be like, what do you mean by high? What's your definition of high probability? And by high probability, my spelling goes out the window when I'm teaching a webcast, by the way. What do I mean by that? I mean, if, there's different ways the stock can go, but above a 50% likelihood of winning something on this. Now, you maybe go, that's great. I want high probability. Yeah, maybe you do, but that doesn't mean it's a great trade. Because remember, you can have a high probability trade, but with a terrible return on risk on the trade. So it still may not make it an ideal type trade there. Okay. The max profit on this, max profit is spread width plus, where's my plus sign? Plus the initial credit. Okay. Just a couple more. I wrote these down ahead of time so I could get these and not space them as I'm telling you there. Now here's kind of the downside of these, because like a lot of this I talk about, hey, that sounds pretty good. Higher probability, collecting premium up front, positive theta, what's not to like in that? Well, these are undefined risk, big potential for loss, or maybe potential for big loss, maybe would be the better way to say that, if it just kind of goes unfettered against you. And so what we probably are going to do in this class is, what we're going to do, we're going to set a stop on these. Okay, so we're going to set a stop, and of course you hear me every week say stops aren't guaranteed. No guarantee to get us out there. But even if you weren't to set a stop, and we will set a stop, but even if you weren't to set a stop, what you would want to do is definitely, when you're entering the trade, and this is true for any trade probably, know your exits. Know where you're going to get out, particularly on these that have the big potential for loss. And what we're going to do is we're also going to close this. This is just kind of a management deal on this. We're going to close at 50% of max gain. One reason is the odds of actually achieving the max gain on this are probably pretty slim on that. So if we can hit 50% of that max gain, great. We'll use that. Now that's in our class. The number you use, I'll leave that up to you to decide, but this is just kind of an area. So there's my first thing. That's kind of the initial thoughts on that. You can, if you wanted to do a screenshot or something like that, you could on this, because let me just mention this. There's a survey link in the chat. We appreciate your feedback. And what I want to do is I'm going to switch over to the Thinkorswim desktop software here in a sec, and we're going to actually illustrate these with a couple example trades. And I thought we'll do one bull, one bear, and if we have time, maybe we'll do more than that. But there we go. So let me move this out of the way. And let's go. And so here's a trade example, okay? Example. I'm going to look at Amazon, and using kind of our basic technical analysis, I'd say it's been kind of bearish, right? Kind of like the market in a sense, and it's kind of bearish. Had a few okay days in a row. We're up 1/3% today, which isn't bad, but I'm going to consider this to be a downward trend, so I'm going to do something bearish. And if we're talking about front ratio spreads, bearish front ratio spreads, are we using calls or are we using puts? Okay. We're going to use puts. Excuse me. I just said that wrong. We're going to use calls. We're going to use calls. Call front ratio spreads are bearish. All right. And what we're going to do here is I'm going to, and I actually put this on my list. So if you're creating your own list, but you may want to consider this, and it doesn't have to be this way, but what I'm going to do is I'm going to look to buy a contract that is basically at the money. At the money. Okay. So right now we're at 195.50. So I'm going to go out and I'm going to go to the trade tab. Okay. I'm going to go to the trade tab, Yes, you guys got that in the chat right. Absolutely. These are calls. And I'm going to go out about a month. Now, here's one reason why. Remember, this is a positive theta trade. We're trying to maximize the theta. And the longer you go out, if we go out to, something out here, theta, the rate of time decay actually is less typically there. As you get close to expiration, typically the rate of time decay is more. Now, we can't go too close because, we'll have a higher time decay, but then we're just kind of speculating on like a 3 or 4 day move in the stock, which we don't want to do. So about a month is what we're going to do on this one. Okay. And we said the stock's at about 195.5, and I'm going to be looking at calls. And so I'm going to go at the money. And so in this case, this will be just a smidge in the money as well, just about 50 cents in the money. And I'm going to just click on the ask price. Okay, so that's my initial idea. Now, for the short call element of this, I'm going to go out of the money, one more step. I'm going to click on the bid price. I'm going to do a control click on the bid price. Control key, click on that. I'm going to do that again though. So I have you can't see that, my quantity. 2 contracts short, 1 contract long. Now I know you guys are looking at this and going, it says back ratio. It's not, it's a front ratio. It's just, that's Thinkorswim. It does that, okay? So, this is, that's the normal proportion that we're going to do. Let's look on the Analyze tab and see what this looks like. But before I do that, let me just kind of remind us, we're kind of bearish on this. The stock's about 195. It's directional, so if it goes down, we want to be profitable. If it holds up, that's okay too, because our max gain is going to be basically right where our short strike is, and our short strike is 200, right in there. So if we kind of go sideways, peachy keen, wonderful, awesome. If it goes down, great. If it goes up, not so great, because remember, it gets worse and worse the more the stock goes against us. So let's take a look at what the trade actually looks like. So I'm going to right click on this. I'm going to analyze this trade, and that is not going to do it. Let's do this. Here we go. Okay, so this is what it looks like. And let me just look here. So we said the stock right now this is the current price, 195. This line right here represents the current price. And you can see if the stock goes down, it doesn't matter how much it goes down. At expiration, our max gain is 220, or our gain down here is going to be 225. Okay, 225. $225. I'm looking at this blue number right there. Okay, but that's not our max potential gain. Our max potential gain is right here, right where our short strikes is, and that's right around 714. Okay, 714 there. And so this is all good territory here. Now notice today's the 21st. This purple line represents today's date. As time goes forward, the purple line is going to get closer to the blue line, meaning time decay is positive. Okay, time decay is helping us out on that one. We said that up front. Okay, so that's all good stuff. Here's the bad news. The bad news is if this stock goes up, the trade gets worse and worse, and I could keep on scrolling to the right all day, and it would just get worse and worse and worse as you go. I'm not going to do that because you get the picture. But that's why we're going to have an exit there. Now, we said, so that's the trade. Now, this needs to match with this. Okay? So we're okay if this goes up a little bit. Now, if I want to shift this down a little bit, I could shift it down a little bit. I could tweak those strikes, no problem on that. But I'm going to leave that as is, I think. But the other thing is we need to put in exits, right? So we're going to put an exit. Remember what we said our exits were going to be. We said we were going to do an exit if the stock goes against us or if we hit half of our max gain. Our max gain was right around $715 or so, I think, somewhere in there. Yeah, somewhere in there, 720, 715, whatever. So half of that is going to be what? 350, 360, we'll say 355. Okay. That's going to be half our max gain, 355. I'm just going to jot that down so I don't forget that. But we're also going to get out if things go south on us. In the case, when I say south, I mean actually north, if you consider north up, because we don't want it to go up too far. Now it can go, we're expecting it can go sideways. Sideways is great. We want sideways. We want down, that's fine. We just don't want it to go up too much. Where's our limit? Well, what I'm going to do is I'm going to say this. I'm going to say we kind of had this in this range here. Recent bounce there. Moving average there. We're giving it a little wiggle room. It can go up here. But if it starts to get above kind of this area-ish, say 205-ish, I'm going to call this my resistance level, but I'm going to give it a little wiggle room because, you know, sometimes when we talk about support or resistance, it breaks it just a little bit. And there's not any super hurry to get out. But if it does go up here, think about our technical forecast on this. Okay, well, our technical forecast is changing at this point because by the time we're getting up here, we're probably starting to look at more of a bullish stock at that point. So we may want to get out. So there we go. That's how we're going to do it. So what I'm going to do is I'm going to go back to that trade, and I'm going to go and I'm going to confirm and send. Okay. So now there's some questions in the chat. Yeah, this is one of the downsides. And I didn't mention this before. I mentioned the risk before on this trade. But something Chris brought up in the chat is another downside. And that is it's going to require a higher options approval level. Probably doesn't matter whatever broker you have. It's going to require a higher options approval level because you have these extra short contracts. Now, remember a couple weeks ago or a few weeks ago, we talked about back ratio spreads where the number of long contracts outnumbered the number of short contracts. Remember that? That one was different. In this one, the short contracts, those are the ones with the bigger risk. Those are the ones that outnumber the long contracts. So it does require that higher approval level. Now, here's what I'm going to do. I'm going to take this single order and I'm going to make it a first triggers OCO order. And then I'm going to put in an order to close. I'm going to create an opposite order, one to get out. And I'm going to create another order and get out. So here's our order to get in. Here's an order to get out. Now, one of our orders to get out was we were going to say, if we made half of what our max gain was. Well, half of our max gain was going to be $355. $355. Okay. So if we get a 215 credit upfront, and I know that number is bouncing around a little bit, and it's going to cost us 220. If we sell something up front for X number of dollars and we buy it back for the same number of dollars, number of dollars, that's break even. This debit right here represents break even on this. But if we want half of our max gain, then, well, if we can buy it back for 315, what do we say? 315. I forgot what I wrote down. $355, then that's a beneficial situation for us. So if I take the 220 and I subtract the subtract 355, I come up with 135. So if I can get out at that 135 credit, then that'd be great. So I'm going to put in this as a 135 credit. Okay. So there's my credit. Let me just make sure so I'm going to show that's a debit. So let me put a negative sign there on my credit. Okay. Credit. Let me try that one more time. There we go. Okay. All right. Now, what about if things go against us? Well, we said we were going to get out if the stock goes above 704. No, I got that wrong. We broke above here. We would say $207, I think is where we said. 207. Okay. So let's go back here. 207. And so I'm going to make this market. I'm going to make this good till canceled. And by the way, this is going to be good till canceled as well. And I'm going to go and I'm going to put on a gear. I'm going to click on the gear. Stock 204. Ted said stock above 204. Okay, thank you. I forgot to write that one down. Or actually, I wrote it down, but I wrote down the wrong number. It didn't make any sense. We said if Amazon marks greater than or equal to 204, we're going to get out. Okay? So that's our stop. Again, stop, it's not technically a stop. It's just a rules-based order to get out if the market goes above us. But of course, we don't know. This could gap way up on us. Amazon could gap to $230 or something tomorrow if we wanted. And so there is a trade. Okay, I'm going to confirm and send this, and we're going to look at this here. And we have two orders to get out. We're going to buy it back if we hit our stop price, so to speak. We're going to, the stock above 204. We're going to buy it back if we hit our target price. And we're going to put that, and I'm just going to leave that unallocated. I'm going to send that order, and we'll let that think on us, okay? And maybe I'll tweak this a little bit after if it doesn't fill. Okay. Let me just double check. Questions. David said it's a negative Vega. Yeah. So, hey, look, implied volatilities, if they drop, they're going to help us out. If they go up, if they reverse, and implied volatilities go up, that would work against us, no doubt. No doubt. Okay, let's see how we're doing okay on time. All right, let's do ExxonMobil. Okay, I want to look at this as a bullish example. XOM, because, hey, look, you look at the markets right now, there's a lot more bearish looking stocks than bullish looking stocks. But I'm going to say, hey, look, we had this kind of sideways stock and we broke above a potential resistance. And, we now have a low and a higher low. And, this is looking like it's breaking out. Now, ExxonMobil, of course, is going to be somewhat related to the price of oil. Oil's been kind of languishing a little bit lately. And so if oil and ExxonMobil's actually done fairly well given that. If oil goes up, you'd expect it to probably help it, if anything. So I'm going to consider that, and we filled on our trade. And I'm going to consider that as, we're going to call that a bullish trade. I'm going to go at the money is going to be 115. I'm just going to jot that down because I tend to forget that. 115 is going to be our at the money. Now, if we're doing a bullish front ratio spread, are we doing calls or puts? Calls or puts, bullish front ratio spread. Okay. Well, we're going to do puts if we're bullish on this trade. I'm going to go out and, again, you can do the month thing. Well, you can also check, and you don't have to do a full month. Let me go, here's 21 days. Sometimes these become a little less liquid here when you are looking at these weekly options. So you'll double check that. You can double check, open interest isn't spectacular. Your bid-ask spread seems okay to me there. So we're going to be looking at puts here on this. And we're going to start at the money, okay? Start at the money. Our stock is at 115, so I'm going to go to 115, and I'm going to buy the 115. I'm just going to click on that ask price, okay? 115. Let me just jot that down. And let's go back. Now we're going to go out of the money, okay? Now on a put, out of the money is going to be a lower strike price. And so I'm going to go out of the money. Now I can go width of 2 out of the money if I wanted to, or I can go 1 out of the money. Let's look at this. I'm going to do 2 out of the money, and I'm going to go, and I'm going to hold down my control key, click on the bid price. We're selling that. I'm going to go to 113 again, click on that, sell that. Here's our front ratio spread. Let's analyze this trade. Okay, I'm going to analyze trade. Here we go. And let me see if I can, it's a little harder to see on this. It just showed me a little more separation here on that. Let me just do that. Does that help a little? You can kind of see the gist of it. Remember, this is a trade that we're bullish on. If we're up here, let's say the stock goes up to $140, which is probably maybe unrealistic in terms of what it's going to go up. $58 gain at expiration. $120, $58 gain at expiration. Okay, you can see that right in that bottom left corner there. If it kind of stays in this range, in about the 110 range, maybe just a little bit above, then our gains are even more. Okay, then our gains are going to be even more. And so we can do that. Now, if we want to get out, we could also say, look, if this starts to go against me down here, I'm going to put in a stop. If it starts to go against me up this, go against me, not against me, go up a long ways, well, we can just stick with it. You don't have to put in the exit at a max gain if you don't want to. You can keep an eye on it and get out when you want. But clearly in this class, what we're going to do is we're definitely going to put a stop if the stock goes down on us. How far down? Well, let's take a look here. So if it can drop down, it can drop down. If the theory is this is bullish. If it drops back down into this slot here, remember our max gain is going to be where our short strikes are. Our short strikes are, I think, the 113 range. That's right around here. So if it drops down, that's great. If it hits there, we're expecting maybe some support here. If the stock continues to go down in this, what we kind of want to avoid is this. This is a channel. I mean, what we really want to avoid is it going way down, but we kind of don't want it to go down to the lower portion of that channel there. So what I'm going to say is if we go down below, say, 110 in this range, I'm going to get out at the 110 level, okay? So let's do this. Here we go. I'm going to right-click on this. I'm going to not analyze trade. We already did analyze a trade. I'm going to do this. I'm going to do first trigger sequence. I'm going to right-click. I'm going to create an opposite order. This is going to be one to get me out. It's not going to be a true stop order. We're going to make it a market order. Good till canceled. Click on our gear. And remember, we said we were going to get out if ExxonMobil marks at or below, less than or equal to 110. Then we're going to get out of this trade, okay? And what I can do is I can confirm and send. Oh, by the way, I should mention this. Right now, this is showing mid price about 55, okay? The natural price is 69. We can enter this with the hopes that things get better. The price gets, price goes higher on us here. Sorry, I messed that up. I was clicking on the wrong thing. Mid price 57. I want to get as much credit as I can up front. Okay. I want to get as much credit as I can up front. Right now, that's the mid price. Well, or higher. Realistically, we may not be filled at that price. So I may be willing to move down. I don't necessarily want to go all the way down to the natural price because that's less than I want to get. So I'm going to move it off there. That's increasing the chances that I'm going to get filled. Now, is the trigger the underlying price? So this trigger right here where it says first trigger sequence means the first order needs to fill before this second order becomes active. When we talk about this second order, this trigger is the underlying stock. That's a good question from Bruce there. And maybe let me just open this up just a little bit here. When you're doing these orders on these conditional orders that I'm doing, this is based on whatever the symbol is right here. Theoretically, I've never actually done this. Theoretically, you could do this based on an option price, but you would put in the option symbol there. Theoretically, you could do this on a different symbol. I could say if the SPX goes below a certain price, I could add that in here. But the default on this, when you click on this, is the stock right there, okay? So that's the stock price going below 110, not the option price on that. Okay, there we go. And you can see that order's right there. So we're going to confirm and send. Now, I mentioned, exiting on the high side, exiting on the low side, or if it's going against you. But there is one other exit that you should always consider. Any kind of trade, I don't care whether this is front ratio spreads or whatever, just long calls or something like that. You should have in mind what are you going to do if the stock goes for you? What you're going to do if the stock goes against you? And what if the stock just kind of doesn't do anything? At a certain point, you're probably going to look to exit most of these trades that we're talking about. There may be circumstances where you let them go to expiration. Remember, short options can be assigned early. On these, what we're going to look to do in this class is we're going to look to get out with about a week to go till expiration. Now, I didn't automate that, and we're going to keep an eye on this in future weeks. And there we go. Okay, there we go. That's how we're going to do that. And I'll give you an example of that in one sec, but let me just address the question. Thea said, do we have a bearish Harami? Right now, that's kind of, we still have an hour and a half left in the trading day. So I don't know where this is going to be. The body of this candle is entirely inside this one, which means that's not keep in mind on these candle patterns, when we're looking at candle patterns, they're not necessarily long-term signals, but could that portend a little pullback? Yeah. Would that hurt the trade? No, that'd be great for this trade, actually. What we don't want to see is we don't want to see a big breakdown in this. Remember, this is a bullish trade or neutral trade. That's why we're calling it a high probability, okay? If the stock stays where it's at, great. If the stock goes up, great. If the stock goes down a little bit, great. If the stock goes down a whole bunch, not so great. So even if you kind of say, well, that's looking a little bit more bearish to me, I don't think in this particular case that's necessarily problematic. Okay, good question though. All right, let's take a look. And what I want to do is, I mentioned this kind of the 3-rule thing to consider. 3 exit thing. Consider if the stock goes or the trade goes for you, if the trade goes against you, or if the trade is kind of just going sideways. We very well may put just a time exit on these. And most of these trades that are just kind of time dependent, theta positive, remember, we don't want to get early assignment. We don't want to, and early assignment, the odds of early assignment go up the closer you get to expiration. Okay. If they go more in the money, the odds of early assignment increase. But so normally with about a week to go before expiration, okay, with about a week to go till expiration, that's where we're going to get, okay? So question is the max gain. Max gain is the credit plus the spread width. Yep, credit plus the spread width. So even if you get kind of a puny credit, that's okay, because you still have that spread width working in your favor there. So good question from Dan. And just a reminder, here's, I set out there's other things I could have added on here, I guess, as well. But remember, the max profit is that right there, okay? And remember, potential for big loss if it goes against you. But there's kind of the initial, parameters we talked about there. Okay, but here's an example of a similar type trade. Not a similar type, different type trade, but similar principle of, this is a calendar spread on Pfizer. We have 7 days to go till expiration on that short contract. We're probably going to look to exit, okay? To roll or exit on this. Now, these aren't too far apart. They're only 2 weeks apart on that. And, we've made a little money on it, not enough to write home to mom about or anything like that, but we made a little money there on that, but we only have 7 days to go. We could roll this out a week, but these are close enough. I'm probably going to look just to get out of the whole thing on that, okay? Same thing with the SPX options. This is a butterfly spread. Kind of same principle. We only have 7 days to go on this. With a week to go to expiration, we're just going to look to get out of it. Okay, so I'm going to close this out. We'll take the little profit we got here on this, and I'm going to create a closing order. We're going to get out of this trade, and that's the mid price. Realistically, we may not be able to get that much. I'm going to do that. Confirm and send that order. There we go. We're out of that. That was a nice gain. Pfizer, it's a little gain, but I'm going to look to get out of this whole thing as well. This is just kind of illustrating the principle. The same one we're going to use as we manage these other trades we just put in. When we get to be about a week till expiration, we're going to look to exit those in this class here. So I'm going to look to get out of that, confirm and send. I'm going to send that. Also, just a reminder, when we talk about trade management, those were a couple nice little profits we took. A lot of the trade management I do in the managing an options portfolio class, which Cameron May actually used to teach. I kind of took that over for him because he moved on to a bunch of other classes. But on Wednesdays at noon, managing an options portfolio, we go through a lot of different types of trades and management. But I felt these two kind of illustrated the point on our Amazon was one we just did on the get out with about a week to go. Okay. All right, everybody. Hey, thanks for joining me. Coming up next, we've got ThinkScript Studies. Make sure you check that out. Mike Fairborn teaches that class. He does a wonderful job on that. I want to invite you again. Please follow Cam, follow myself on X at Cameron May CS, at Brent Moore CS. I think there was a survey in the chat. I forgot about that. I should have mentioned that more. So Ted, last question as we're going. Are fills and paper money based on, I don't know exactly their formulas for fills on paper money versus the live platform. Obviously, they're looking at the market data to do those fills. The reality is, I would say my experience is paper money is a little bit more generous on fills, on getting you filled than the live platform. It's a great platform, don't get me wrong. But sometimes it is a little more generous there on your fills there on that, okay? So why exit 7 days before expiration? Number one, we don't want to get assigned the options And remember, trade has a big potential for loss. So we don't want this to go from a good position to a completely terrible position in just a few days' time. That's why we're exiting early. Okay, everybody. Hey, thanks for joining me today. And we'll see you all same time next week. Bye-bye, everybody.